Have you ever wondered how the U.S. banking system became what it is today? From wildcat banks to trillion-dollar institutions, the journey has been anything but smooth. Over more than 2 centuries, banking in America has evolved through innovation, crisis, and reform. In this video, we'll take a closer look at the most important events that shaped the U.S. banking industry. How it started, the mistakes that were made, and the lessons that still impact us today. From the founding fathers to modern-day fintech, the story of American banking is deeply connected to the country's economic and political history. Whether you're using a mobile banking app or investing in crypto, this system touches all of us. Let's dive in and explore how it all began. The U.S. banking story begins in 1791 with the first Bank of the United States, created by Alexander Hamilton. It was America's first try at a central bank, made to help the government pay off the large debt from the Revolutionary War and support the country's new economy. Hamilton saw a national bank as important for growth, but not everyone agreed. Thomas Jefferson and others argued that a central bank gave too much power to the federal government. As a result, the bank's government approval ended in 1811. A second bank was approved in 1816 but faced strong opposition from President Andrew Jackson, who shut it down in the 1830s. Jackson believed it favored elites and hurt ordinary citizens. This led to the free banking era, where state banks operated without federal oversight. Many printed their own currency, which often became worthless. Bank failures were common, and public trust in the system was low. It was clear something more stable was needed. That need became urgent during the Civil War, when the U.S. faced a divided country and a messy banking system. To help pay for the war and fix the banks, the Northern-controlled Congress passed the National Banking Acts of 1863 and 1864. These laws created a single national currency and set up national banks backed by the U.S. government. A key move was placing a heavy tax on state-issued currency, forcing many banks to adopt the new national standard. For the first time, there was an attempt to unify banking practices across the country. While this system reduced confusion and created a more consistent banking environment, it still lacked a central authority. This meant there was no control over money supply or response to economic shocks. This problem became worse. Between 1873 and 1907, banking panics hit the U.S. hard. Risky investments and low reserves led to chaos. People lost trust, rushing to withdraw their money. Banks failed, just as feared, worsening the crisis. The Panic of 1907 was a major turning point. A trust company collapsed, spreading panic everywhere. Without a central bank, J.P. Morgan stepped in. He organized a $25 million rescue to stop the collapse. This showed the need for a central bank in the U.S. A stable financial system couldn't rely on private individuals. That's why in 1913, the Federal Reserve System was created to make the U.S. financial system safer, more flexible, and more stable. It was given important powers, such as issuing money, setting interest rates, and helping banks during financial emergencies. The Fed was designed as a network of 12 regional banks, overseen by the Federal Reserve Board in Washington, D.C. This setup aimed to balance public and private interests, and to prevent too much power from being held in one place, while still allowing for centralized control of monetary policy. Initially, it struggled, like during the Great Depression, but it learned and evolved. Although the Fed gave the U.S. better tools to stop bank failures, it didn't work perfectly at first. During the Great Depression, for example, it failed to stop many banks from collapsing. Over time, the Fed's policies improved, but the mistakes made during that crisis taught important lessons about its role in the economy. The Great Depression started with the 1929 stock market crash. But soon, the banking system crashed too. Between 1930 and 1938, over 9,000 banks failed. Millions lost their life savings and trust in the system. President Roosevelt responded with the New Deal reforms. The Banking Act of 1933 created the FDIC, insuring deposits. Now, even if a bank failed, your money was safe. The Glass-Steagall Act separated commercial and investment banks. These reforms stabilized the financial system for decades. For the next several decades, bank failures became rare, and the system grew more reliable. But starting in the 1980s, the government began to loosen rules on banks. This led to the savings and loan crisis, where many banks made risky loans and weren't well watched. Over 1,000 banks failed, and it cost taxpayers about $125 billion. Still, the push to reduce rules continued. In 1999, Congress ended the Glass-Steagall Act. This change let banks mix regular banking with investment banking again. Big banks got even bigger and started trading complex financial products like mortgage-backed securities and derivatives. Then came the 2008 financial crisis. It was caused by risky home loans, called subprime mortgages, and too little regulation. A major bank, Lehman Brothers, collapsed. This caused panic worldwide. To stop everything from falling apart, the government gave out huge bailouts, including a $700 billion program called TARP. After the crisis, people argued more about bank rules, risk, and responsibility. In 2010, the Dodd-Frank Act was passed. It added new rules to control risk, watch over banks more closely, and protect consumers. Today, the world of banking looks very different. Traditional banks now share space with mobile apps, digital wallets, and financial technology companies like PayPal, Venmo, and Revolut. People can send money, buy stocks, or apply for loans using their phones. Cryptocurrencies like Bitcoin offer a new way to handle money. These are not controlled by banks or governments and offer a new way to handle money. Even though their value can change quickly, they have made people more interested in the technology behind them, called blockchain. Some governments are even thinking about making their own digital currencies, known as central bank digital currencies or CBDCs. At the same time, big data and artificial intelligence are changing how banks work. They help improve customer service, find fraud, and decide who can get credit. But new technology also brings new problems. It is more important than ever to protect data, stop cybercrime, and have clear rules for the market. The main purpose of banking is to keep money safe, lend it to others, and help people make payments. This has stayed the same, but the way we do these things is changing very quickly. As technology moves fast, the people who make the rules are always trying to keep up. The U.S. banking system has changed a lot, from the first national bank to today's banking apps and digital money. Every time there was a problem, people found new ways to fix it. By learning this history, we can better understand how money works today. Even with all the new technology, the main job of banks stays the same: to keep our money safe and help it grow. Thank you for watching, and we hope you learned something new. See you next time.